Happy Halloween and welcome to the Mortgage Meltdown. So, on behalf of John Quigley, all of our colleagues here at UC Berkeley, and certainly all of us from UCLA, welcome to day 2 of our conference. We're very pleased to have you here today. We have a wonderful agenda for today. It's very full. We're going to get to it momentarily. We have our good friend Chip Case, who will be up in just a moment, and moderate a panel that includes papers by Ed Leamer and Bob Shiller. And subsequently to that, as you know, we will adjourn to across the way to what's called Zellerbach Playhouse. And there we will receive remarks from Chairman Bernanke on the topic of the future of the U.S. mortgage finance system. We've also asked a number of our colleagues to be impromptu as a panel to help articulate and field some of the questions that pertain to the Bernanke presentation, so that Christy Romer will moderate this panel, and then we're going to have Bob Hall, Dick Roll, Aaron Edlin, and Barry Etchegreen all participate in that panel. With no further ado, let's get into gear here, and I'm going to ask Mike Schill to come up and say a few words. Mike is our Dean of the School of Law at UCLA, a professor of a professor of property law, and an esteemed housing researcher. Mike.
Thank you, Stuart, and welcome, everyone. As Dean of UCLA's Law School, I get to do a lot of welcomes, probably a few too many welcomes, and I know that the key thing in welcome is to be brief, and I'll do that. I'm especially delighted, though, to be here today, and there's a number of reasons for that. Before becoming dean, as some of you know, my area of scholarship was in the area of housing and real estate finance, and it's really wonderful for me to be here today to really return to my first love, and to also see so many of my friends and colleagues who I haven't been able to see for the past 4 years at UCLA. And today, it's also wonderful today to be welcoming you because of the importance of the subject that you're talking about. Of course, it's important because it's my subject, but it is important also because of course, we are dealing with one of the biggest economic crises of our time. And this is a unique event. And it's a unique and important event for a number of reasons, but one of the reasons why it's unique is that it represents the first joint event of Berkeley's program in housing and urban policy and UCLA's Ziman Center for Real Estate. And then I'd like to thank John Quigley and Larry Rosenthal for putting this together with Stuart. I mean, this is just an amazing, amazing conference. I'd been hearing about this from all sorts of people at UCLA for a long time, and it's really wonderful that we have done this, and that hopefully we will get lots more opportunities in the future to do joint endeavors between the Big Bear and the Bruin down in a little farther south. Although I will say this is the first rain that I've seen in, I think, 8 months. So I'm going to look forward to getting back to Los Angeles this evening. The other way that this is unique is that is thinking about the Ziman Center at UCLA. This is the first center that I know of that in the United States that combines the strengths of a management school and a law school. And as all of the papers written for today comprehend, and as much of what we're going to talk about today comprehends, and indeed Susan Wachter and I were just talking about this a moment ago, a lot of what is going on in the current crisis has to do with law and regulation and either the lack of enforcement or the lack of appropriate law. And of course, as in most areas of human endeavor, law will be part of the solution. So I'm very much looking forward to the papers today and to gaining insight about that, because we are training the next generation of leaders who will help us through this, as well as the research that we do at the school. So again, welcome everyone, and I'm looking forward to seeing all of you later on.
Okay, we're going to ask our first set of speakers and panelists to come up. Chip Case, of course, will moderate, and Chip come on up, please. Ed, Bob, and our panelists, if you could please join us at the front of the room. Thank you.
I'm going to introduce our the paper writers first, and then sit down and shut up. We got plenty of time today, which is nice. We don't have 7 minutes for each paper. We've got 20 minutes for each paper and 10 minutes for each discussant, if that sounds right to you guys. I first met Ed Leamer 37 years ago when I showed up at Harvard getting out of the Army. And I didn't know a bordered Hessian from a cow. So I took statistics and math for retarded people. And the statistics for retarded people was taught by Ed Leamer. And not that he was retarded, it was that we were retarded. And the thing about that class was, it was my first graduate school class, and I was terrorized. But the first exam in that class was it was at the 11th hour of the 11th day of the 11th month in 1971. It's sort of burned in my head. It was the armistice. And so I failed it. And I went looking for jobs in prep schools. But I ended up doing all right in that class. And about 3 years ago, Ed called me up and asked me to come to UCLA and give a talk. And I said, this really feels good. Back in 1985, I decided to go down to the Federal Reserve Bank of Boston for a year and write a textbook with Ray Fair. And while I was down there, the deal I cut with Frank Morris was president of the Federal Reserve Bank of Boston at the time, and the deal I cut with him was I'd get subsidized lunch, a place to play squash, and some good colleagues in exchange for an article or two a year for the New England Economic Review, which is the local economic rag up there. So it was 1985, and my house went up 40% in value that year. And I knew it. And I also knew that you could get on that horse and ride it. That you're not supposed to know that in capital markets, but somebody said to me, the only thing dumber than not owning a house right now is not owning two. And so I didn't buy two, but I bought one. And it was one of the smartest things I ever did. But so I went down to the Fed and decided to write a piece on why this was happening. And I did what people do. I built a model. It was a pretty good model. It had 10 cities worth of data over 10 years. I couldn't measure house prices very well, so I did some scribbling on the back of an envelope and tried to sort out the rudiments of a repeat sales index. But the fun part of the paper was trying to explain this price pattern, and it was one thing stood out like a sore thumb: Boston. Right? Boston was supposed to go up. If you look at there was a demand and supply curve in the model. It was identified. I got a positive sign on the supply curve with price and a negative sign on the demand curve. It was a nice model, had a lot of demographics in it, and it didn't explain Boston. It said Boston should go up 15%. Boston went up 150%. And so I was out on a limb, and I was having lunch with Ray Fair the next day. Not the next day, but about 6 months after that. And I said, who understands bubbles? He said, the guy across the hall. So he sent me down the hall, and there was Bob Shiller. And a week later, we were sitting at my dining room table scribbling out the essence of our first paper, which was back in '85. No one in my life has been better to work with than Bob. We kind of got married. We've done a lot of work together. We survey home buyers every year, and I admire his work. And he's taught me a lot of finance. I've taught him a little bit about real estate, and it's been a good partnership. So it's going to be fun. So I'm going to start out with Ed. Ed's going first. About 6 months ago, I got a phone call from a Boston Herald reporter who said, "Tell me something positive." So I scratched my head, couldn't think of anything right off. But then I said, let me send you two tables. And I sent him the table of housing starts. And if you look at housing starts back to '73, the peak was in 1973 at about 2.5 million. And then from then till now, it's been unbelievably regular. it goes from 2.5 million down below a million in the recession of 75. Then it comes back to 2.25 million. Then it goes down to under a million again. Then it comes back in the late 80s to 2.25 million at peak, and then drops to in the recession to below a million again. And so it goes up to 2.25 down to a million, up to 2.25 down to a million. And if you look at residential fixed investment in the GDP accounts, and you take the ratio of real residential investment to real GDP, it starts at 5.5, goes to 3.3, 3.4, 5.5, 3.5, 5.5 over the cycles. Right now, if you look at those charts, they all say it's a bottom compared to all the others, but it's blowing right through it. Instead of 3.5% of GDP, it's down to 3.1. Instead of stopping at a million or 900,000, it's down to 817,000 on starts, and it doesn't show any signs of recovery. But if you're a chartist and you look at those, you feel like it's getting close to a bottom. So I'm going to leave that with just to whet your appetite on what Ed's going to say about the cycle.
Okay, thanks very much, Chip. I was afraid you were going to ask me to review your exam again to try to read that. I feel a little bit out of place because, as far as I can tell, all the other papers that you're listening to have to do with the finance side, not the real economy. And for example, I don't think housing starts is mentioned in any of these other papers. And I'm a real economy kind of guy, and I think it might be appropriate to think a minute about the relationship between Wall Street and Main Street. And there are really two metaphors, I think two prevalent metaphors for thinking about the relationship. One is what I'd call a shadow, meaning that over here we have the real economy, where the factories, offices, homes, people going to work, you can smell it and feel it. And then you have the shadow of the real economy. That's the financial side. Sometimes the shadow is long and sometimes it's short. So here in the business of selling the shadow, and it starts to shorten, you have this fear that it must be the real economy is shrinking too. But let's understand that incredible collapse in equities prices, those are just numbers on hard drives. And you drive through San Francisco and Denver and Chicago and St. Louis, you try to find the earthquakes and fires and floods that destroyed $10 trillion worth of wealth. Well, the real wealth is, of course, unaffected. All that's happened has been a reevaluation of that. So that's a shadow. That says, as important as you financial guys might think you are, you're really only the shadow. There might be some feedback. You'll see it in a little bit that there is, in my view, some feedback, but namely a wealth effect on the real economy. But it's not as dramatic. And the wealth effect, of course, was tested in the 2001 downturn when we lost $7 trillion worth of spending, of wealth, but the consumers kept on spending. But the metaphor that seems to be driving the policy on Wall Street is the grease. Or another one is a toilet metaphor, which is that the system is clogged, and therefore we need the taxpayers to spend $700 billion to buy this. To buy all these mortgage-backed securities. So the grease idea is you need credit. You obviously need credit to keep the economy going, and that's why we have this incredible crisis, and the whole real economy is going to collapse. But you got to understand that it's a consumer cycle, and the really bad news out of that third quarter GDP release is a sharp decline in consumer spending. With consumer spending, there are no business opportunities, investment opportunities. Who cares about credit when consumers aren't buying? The critical problem with the U.S. economy over the next couple of quarters is weakness on the consumer side. And if it continues to weaken as it is, we're going to have a real recession, never mind the crisis on Wall Street. So the focus on, in the policy discussions, even just yesterday, Eddie Lazier said, we don't need to have a stimulus package. We need to give the TARP more time to have its impact. Well, I think that's utter nonsense because we really do need a stimulus package or we're going to have a more severe recession. The problem's on the consumer side. And to kind of make that point as clear as possible, I ask you, what is this year's scariest Halloween outfit? The answer is you want to dress up like Secretary Paulson. Because he got a $700 billion treat by threatening with us with a Great Depression, which to my mind was the most far-fetched, ridiculous thing. And if you contrast what our leadership did compared with what FDR did after he closed the banks, FDR gets on one of those fireside chats on the radio saying, as bad as this crisis is, the most important thing that we Americans have, the most important thing that our financial community has, is trust and confidence. The last thing we want to do is have you run around fearful and rumor mongering, and together we cannot fail. Something to that effect. Very positive kind of statement. Instead, what we got from our three critical leaders, Bernanke, Paulson, and Bush, is if you don't pass this thing by Friday, we're going to have the Great Depression. What they didn't tell us, though, if we did pass it, would we have the Great Depression? And they left most of us thinking, oh, they know something, we're going to have the Great Depression. So then as a consequence of that fear, we're taking defensive action, which means sell equities at any price and put our money in a mattress. And the next thing is, when you earn any money, you don't want to spend that. You want to put that in the mattress, too, because you got to squirrel that stuff away for the Great Depression that's coming. That's what's going to cause a downturn. It's fear on the part of consumers. We need to relax. We need to increase savings, but let's all relax, understand a little bit of spending during this holiday period isn't all that bad. That's a little bit off target, but not completely. So here's the outline of this paper. A year ago, I went up to I went to that Jackson Hole conference and suggested that the Fed should place more interest in the housing sector. In fact, to the extent that we ought to replace housing starts and the change in housing starts in the Taylor rule, instead of using the output gap, to use the starts and the change in the starts. The problem with the output gap is it's backward looking. You need a forward looking measure. You want to have a policy put in place not for what it used to be, but what the economy is going to be in a few years. And the Fed response was, we don't do sectors. You know, literally, that was virtually a quote. Of course, I wasn't interested in sectors. I was interested in smoothing the business cycle. So that's the question that I pose today. If the Fed targeted housing starts, I think it's pretty clear they could control housing starts, but would that reduce the amplitude and frequency of U.S. recessions? And that's by way of introduction. Then the first section deals with all these data displays and tables that basically make the point that it's a consumer cycle, not a business cycle. We call it a business cycle, but it's consumers who are the drivers. They lead the way. We've had 8 downturns since World War II. Eight of them have then these V-shaped recessions in which we have a sharp drop in consumer spending, lose a lot of jobs. That's the first stroke of the V. The second stroke of the V is the housing and durables improve. And jobs come back. At the end of the second stroke, you're back to pretty much where you were. We've also had 2 structural adjustments, which Bob Hall and his friends at the NBR Dating Committee call recessions, but they're really rather different in the sense that when that recession is over, you're not back to where you used to be. One of which was the Korean War disarmament. So you had the fraction of GDP spent by the DOD went up to 14%, and within a year and a half it had been down to 7 or 8%. That's a heck of a hit, and the U.S. economy can't absorb that without a big increase in unemployment and weak GDP growth. That's a structural adjustment. It calls for a different kind of monetary policy than the V-shaped kind of consumer downturn. The other one was that 2001 event, which is an internet comeuppance. We had let the fraction of GDP spent on equipment and software rise to an all-time level, high level in 99, 98, 99. And then disappointing profitability on the web led businesses to cut back very heavily on their investments and personnel, IT personnel. And that was a structural adjustment in the sense the economy afterwards was not the same as it was before. We're entering a consumer downturn right now. Not one of these, not a business-led downturn. It's not a question of business credit that's driving the downturn. It's weakness in consumer spending. The temporal ordering of the weakness in consumer recessions is first homes and then automobiles, homes and durables. Before the recession begins, it's homes and durables. Then, when the official recession has occurred, that's when you get weakness on the business side, which is first the short-lived assets, equipment, and software, and last the long-lived assets, which are the business structures, offices and factories. If you wanted to control or prevent this cycle, it seems like you want to focus on the components of GDP that are weak prior to the downturn, which are all on the consumer side and mostly homes and autos, although the other parts of consumer spending are also weak. So the idea of focusing on homes is not only to attenuate, smooth the cycle in homes, but also to have an impact on consumer spending more generally. So then I'm going to offer a 3-equation structural model. And I use the word structural, meaning I'm going to act as if it were the causal structure of the world. But I know as well as anybody in this room that temporal orderings don't imply causation. And teasing real causal conclusions from macro data, I think, is really impossible. And if any of my discussants use the word instrumental variables, I've warned them ahead of time that I have Joe the plumber in the back, and he's going to come up and thrash them. So or another way of saying it, it's not about proof here, it's about persuasion. It's not proof persuasion. You're not going to be able to draw scientifically valid causal conclusions from these macro data, in my opinion. So then I'm going to do, having estimated this 3-equation model, I'll do a simulation in which the interest rate is chosen to stabilize housing at around 1.55 million, which is about the historical level. Housing starts at that number, meaning that you're going to try to eliminate 15% of the difference between housing starts and their normal level in any given quarter. You don't try to adjust it all around. You drive it smoothly toward its normal level. And then we're going to see that with and without the residuals included. I'll tell you why in a minute. And then finally, we're going to do 2 starting points. One is in 2000, when Greenspan was raising interest rates. If you remember that, going into that downturn, or possibly precipitating a downturn in 2001, he was raising interest rates. So let's see what he would have done had he been targeting housing at that period of time. And then the other, starting point is in 2006, when Chairman Bernanke took over. Now, he was dealt a rather unfortunate hand, since the housing starts were virtually at the peak in January of 2006 when he took over, and for sure they're going to decline, probably precipitously. So he had a heck of a problem figuring out how to control the monetary policy facing that incredible imbalance on the housing side. But still, we can ask what he would have done had he focused completely on the housing side. And now, what I'm going to do is create these, what I'm calling cumulative abnormal contributions to GDP. This is GDP and the cumulative added up, not compounded. And then through that, I'm going to put what looks like a straight line. The slope of that straight line is the normal GDP growth. And deviations from that are going to be normal. The straight lines that I'm going to put in here are actually 3. You can't see, but there are 3 different episodes. For the other components of GDP, this is what I'm taking to be the normal cumulative contribution to GDP. And these are these spline regressions with the optimally chosen join points, allowing for 3 different trends, or 3 different average contributions to GDP growth. And Michael Schill looks totally befuddled by this. Okay, let's maybe back up a little bit. So the BEA computes a table which calls contributions to GDP growth. GDP growth is 3%. Of that 3%, typically 2% is on the consumer side. And then there's the other components of GDP. I'm going to work with all those components that add to about 3. And I want to find out when those components are normal and when they're abnormal. When they're weak compared to normal, when they're strong compared to normal, particularly focusing on around recessions. So the first step is to figure out what's a normal contribution to GDP. So, and that's what this picture is, a normal trend line of the cumulative contribution. If you're not following me, it doesn't matter. This is the picture that you have to have. This shows you what's happening to the volatile components of GDP around recessions. This is the cumulative abnormal contribution to GDP. And all you have to do is see the difference between level sloping downward or sloping up. If it's level, that means that the normal and the actual are equal quarter after quarter, because when you accumulate them, there's no change. So level means normal. In this picture, level means normal. Down means you're subtracting from GDP, meaning that component is weaker than normal. Up means it's stronger than normal. You're supposed to look at this and say, well, which are the normal and which are the weak components of GDP prior to the recession? So we got on the horizontal axis, we have the quarters before the recession to the left, quarters during the recession to the right. And what's weak is homes and durables. And homes peaks around about 3/4 before the official recession begins. This is on average, 3/4 before, and the durable peak is almost the same. This cycle that we're in is very, very different because we had a housing peak at the end of 2005, and we didn't get to the weakness in durables really until this year. So there's a huge delay, a totally different kind of episode than we're having. Historically, there's a close coordination between homes and durables, their cycles. And you can see before the recession begins, the equipment, structures, and inventories are either flat or rising. I mean, there's nothing abnormally negative with regard to those components of GDP. It's a consumer downturn, not a business downturn. And then when this recession begins, that's when you get the business spending weakening, and then it dives down. And if you look carefully, you'll see exactly the ordering I said, which homes moves first and then bottoms out first, then durables, then equipment and software, and finally structures. So that's the seven consumer downturns. This is all of them together. So this is the residential investment component of GDP. And the dark line is the average that we just looked at. We can see that most of these cycles are very similar to the average. There's a high degree of similarity in terms of the contribution that residential investment is doing to GDP, except for these two oddball ones, which was 1953, that was the Korean War, disarmament, structural adjustment, and 2001, which was our internet comeuppance, in which housing didn't play much of a role. Okay, in which housing didn't play much of a role in the downturn. You can also see, I left out 1948. 1948, it has a consumer downturn going in, but it has a very sharp recovery and a bit odd, and therefore I didn't average in to create that average 7. The consumer durables has a lot more noise. So although consumer durables on average has a shape that's very similar, it's a lot more noisy. And to kind of confirm the noisiness of consumer durables, I run a regression that explains the growth of GDP as a function of individually the lag GDP or the components of GDP, and which ask which one of these components best predicts future GDP. And included in there are nonlinearities. I mean, we're going to allow cubic functional form and also long lags. So kind of throw in the kitchen sink and ask which one of these predictive variables really works well. The answer is the R-squared for resonance is 30%. And none of the other ones comes close. So GDP doesn't predict itself. Weakness in GDP one quarter doesn't predict GDP the next quarter. Most of the other components don't matter, so its resonances are the real predictor. Reconfirm. Now, this is a picture that confirms the same thing. And this is the cumulative abnormal contributions of homes and defense. This is a picture that tells you about 95% of what you need to know about the U.S. cycle. And if you look carefully, the homes is diving down into every one of these vertically striped reds. So you're getting weakness in homes, predicting, giving you a warning that you're going to have a recession coming soon enough. Now, there have been 2 false negatives and 2 false positives. So if you rely on housing as a predictor, you got to worry about false negatives and false positives. False negative meaning a downturn that was not preceded by an alarm that came out of housing. We've had 2 of those. The 2001 downturn and the Korean War downturn, they were both false negatives. And they had, their sources were not from the consumer side, they had other sources. But there have been 2 false positives. One false positive was back in 1951 when housing was weak and diving down, but we didn't have a recession. The reason DOD ramped up spending big time for the Korean War, offsetting weakness in housing. Another false positive was in 1967, and that was offset again by big spending by the DOD. So that leads you to a rather troubled future here, which is either we're going to have to ramp up the war on terror or we're going to have another recession. And then this picture shows you how closely coordinated the cycles are in homes and durables. They really are closely coordinated. So the presumption or suspicion would be that if you control the problems in housing, maybe incidentally you'll control the problems on consumer durables as well. Now, so that gets me into this modeling that I try to do. In this three-equation model, one of the first things I want to know is what determines starts. And one potential predictor of starts is the cost of housing, meaning the price of housing times the sum of the depreciation, interest rate, minus the appreciation of homes. So that's the rental cost of homes. Those are two different indicators of the rental cost of homes relative to GDP, GDP deflator, which I'm taking as a measure of rent. So this is a choice between renting versus buying. And when renting is cheap, that's when you get a lot of starts. When ownership is cheap, that's when you get a lot of starts. When ownership is expensive, measured in this way, that's when you don't get many starts. So this is rather remarkable. Starts are inverted, rather remarkable similarity between the measure of the financial cost of homes and the actual building of homes. Close coincidence, which makes you think that an equation is going to work pretty well. So this is my housing starts equation. And the target I'm going to use is 1,550,000 starts. The dependent variable is the deviation from that target. And this has a persistent, meaning a lag dependent variable. There's a momentum effect, meaning that as homes are increasing, as starts are increasing, they tend to continue to increase. There are two cost drivers, an interest rate and an appreciation. And these two coefficients, those two coefficients being equal and opposite means it's really the cost variable is the interest rate minus the appreciation. So it kind of fits into the drawing that I just gave you. And then lastly, I've got this yield curve. So a steeply sloped yield curve is good for housing, and an inverted yield curve is bad for housing. I know that the bond market both is a predictor and a cause of recession. But I'm going to take it to be a cause, and I'm going to think of the yield curve as a lending standards variable, meaning that when the yield curve is steep, banks are making intermediation profits, taking loans at low rates of interest and lending at high rates. And in that kind of environment, they want to push loans out the door, because even though some loans default, they're still making the intermediation profits on the ones that don't default. But when the yield curve flattens or even inverts, then the banking operations have to shift away from pushing loans out the door to making sure that the borrowers are creditworthy. So I take that to be the grease, if you want to put it. That's my grease variable in this system. And then this is the appreciation equation. This is the appreciation. So we now have appreciation of homes. HPI is the Alfeo Home Price Index. This has a momentum effect, meaning that if home prices are rising rapidly, they're going to continue to rise. There's an interest rate effect in the dynamics, meaning that rise in the short-term rate, rise in the long-term rate tends to slow down appreciation. It's an error correction model. Long-term equilibrium is a inflation-adjusted trend, meaning the real home prices ought to be increasing at a constant rate adjusted for inflation, but which depends on the real rate of interest as well. So that's the long-term equilibrium that comes out of this equation, which seems very sensible. And this is sales of cars and light trucks, which is the key component in durables. Durables are cars, furniture, and a bunch of little other stuff. Cars and furniture are roughly equal in magnitude and importance, but the furniture naturally is going to go hand in hand with housing. So I want to focus on whether cars are in this do or not. In here, an important driver variable is the appreciation of homes. So that's the shadow having an impact on sales of cars and light trucks. There you see that log HPI of -1 divided by HPI of -5. So my model has both the grease and the shadow. The grease affects the housing starts, and the shadow affects the sales of cars. Now, in other work that I've looked at, I'm more inclined to think that the home wealth affects the quality of the car and not so much the units that are actually sold, although here it looks like it's the units that are the driver. and there's an important market saturation effect in here too, which means if you throw in that long-moving average of historical sales of cars, then that becomes a negative and drags on future sales. So now let's, and then one more thing.
Same thing true of housing?
Same thing's true what?
Is the same thing true of housing?
No, I couldn't pick it up. I'm sure if I worked hard enough, I could. That's my way of saying none of these equations are cast in stone. It's persuasion, not proof. This is the appreciation. The residuals in the appreciation, you can see that there's this burst in appreciation, 5 more minutes, burst of appreciation in 2004 and 2005, which I take to be a subprime, the consequence of the innovations of subprime, bringing in a whole new cast of potential buyers into the market. And as a consequence, I'm going to run this model both with and without the residuals in. With them in, that's including the subprime market. With it out, that's imagining that the new policy I put in place is going to eliminate the egregious loans that were given in 2004 and 2005. So here's the simulation. Doesn't seem so clear. I should be able, but that's the 3-month Treasury, basically under control of the Fed. It's very similar to the Fed funds rate. Very rarely does it very, very much. And you can see that Mr. Greenspan was jacking it way high, dropping it way low, jacked it up high again, and jacked it. What was all that volatility about? I mean, we need to have some policy making that looks forward and is anticipatory, not reactionary. So my interest rates, rather than jacking up in 2000, they tend to go down because housing wasn't all that high. It was kind of normal, but it wasn't. It didn't need to be slowed down to the extent that it was slowed down by the jacking up of those interest rates. Or in terms of the steepness of the yield curve, the spread, we needed a steeper yield curve in 2000, not a flatter yield curve. Definitely not an inverted yield curve. That was going to kill off housing big time or be hard on housing. So then you let the yield curve float down a little bit, jack it back up. If you do that policy, the appreciation is eliminated, that wild appreciation is eliminated, mostly because we got rid of the residuals. And then what happens to housing starts? Housing starts is nice, smooth. You don't have that catastrophic increase and a big decline thereafter. And then the kicker is, what about, what does that policy do to sales of light trucks and autos? Well, we were having these 17 million unit years for 3 or 4 years. That's not a sustainable rate of sales of automobiles. And what this policy does is it slows that down dramatically in 2005, 2006, down to a 15 million unit level, which is a much more sustainable level. Then you don't get the big collapse that happens in 2001. Now, if you add the residuals, and then the appreciation doesn't go away. You're going to have a big kicker from the appreciation. If you have that big kicker from the appreciation, then my interest rate setting rule requires you to offset the positive force of that appreciation on housing starts by higher interest rates in 2004 and 2005. So you have to lean against the innovations in the subprime market. If they start kicking up the appreciation rate, you lean against it with higher interest rates, a flatter yield curve to try to keep housing under control. And if you do that, housing is going to dip down a little bit, but not as dramatically as it actually occurred in 2007 and 8. And then what about cars and light trucks? Well, they too they're not as controlled as well, but they're under substantial control, much better than they would have been otherwise. So bottom line, to kind of wrap this up, my conclusion, monetary policy should be more forward-looking. The Fed needs to recognize it's an intertemporal control problem. The medicine they give out today affects the medicine that influences the effects of the medicine provided later. And they seem not to realize that. They take a one-year view with regard to rate setting, not recognizing that the rates set today affect the impact later on. Housing starts and the changing housing starts form a very accurate forward-looking index. I don't know a better one. Controlling housing starts is like pushing your daughter on a swing. There's one ideal time to intervene. So you're pushing your daughter on a swing, you push at one point. The right time for the Fed to intervene is when housing starts are high and growing higher. So you got to cool down the market at that time. Otherwise, you don't have a lot of impact. Certainly none now. certainly that lowest reduction in interest rates is totally irrelevant as far as housing is concerned. If housing is not allowed to get out of control, it won't get out of control. Housing proximate targets, good for consumer durables. It seems sure to attenuate the amplitude and frequencies of our recessions. If problems of housing are allowed to get out of control, it's very, very difficult late in the game to take corrective action, which is what Mr. Bernanke is regrettably discovering. And then finally, if there is a financial innovation like subprime loans, in my context, retain those residuals, then the Fed monetary policy probably not enough. You need to have some kind of regulatory response as well. Okay, thank you very much.
Stand over here. Okay. I wanted to first clarify that Chip and I are not married.
You could be. This is California.
I know. But we are kindred spirits, and I'm like Chip's memories of our early encounters. I thought I should add something that Ed Leamer is another kindred spirit, and I was going to remember how I met Ed. This is from my memory, and it was close to 40 years ago. So, as I remember, you were an assistant professor at Harvard, and you came to MIT, where I was a graduate student, and you gave a seminar on your new book, Post-Data Model Construction. Do I have that right?
Almost.
Okay. Well, I remember that I was inspired. I also remember, it's interesting, you are a good person with metaphors. You had Grease and Halloween costume metaphors up. And I was trying to remember, what metaphor did you use in 1970? And it seems to me, this is just from my memory, that you held up some prop. You had two rulers. Is this something like that? One was straight, and you were saying one was curved. And this is the problem with econometrics. They're using this curve. Do I have that right? But you don't remember exactly what you held up. So I was very inspired because I had the impression that econometricians, somehow their methods seemed to get the best of them, and they weren't connecting with the problem. And so I went over to Harvard. I went across town, and I sat down in your office. And your thinking has inspired me ever since, I think. So something about, we have to connect with the data.
Change your fryer.
Change my, well, and we're Bayesians. And, but that's a long time. Then you came out far away to California, and we kind of went somewhat separate ways, cut off. And I got very interested in behavioral economics. That's psychology applied to economics, which is still a fringe group, I think, in the profession. And I heard nothing from you about that. So have you gone through a behavioral transformation?
No, I'm planning on it.
All right. So I think that the crisis that we're going through now is the result of bubbles in the stock market and the housing market. So what I want to talk about is that our policies have to think about bubbles and their recurrence. And I want to go very briefly, because I don't have actually that much time, do I?
20 minutes.
Yeah. I want to go through my etiology of the current crisis, which relies heavily on social psychology and sociology. Sociology is the least popular among economists, but I'm starting to think that they know something. And then I want to talk about, I have a book that came out in September called Subprime Solution, which is my set of recommendations for policy. And I'm going to go through some of the ideas that are in that book, but I have changes. Things are changing so fast that my book, I thought it was timed well for this, but unfortunately it's getting dated by the day. So many things are happening. But I still think that basically I'm thinking about long-run solutions that will really matter. And I think that's still valid. So the basic idea is that this crisis should be considered an opportunity. Another point, I don't know how many times economists remark on that, but politicians really don't listen to us very much. And there's this beautiful edifice called financial theory about risk management. But nobody knows that. The congressmen don't get it. And the theory has at its core individual utility maximization. It's about people. That's all that matters. Companies don't matter, right? This is very basic in finance. People matter. And we should have institutions that manage these risks. And finance theory would say we want to diversify risks. We want to get people out of their idiosyncratic risks. So this is a chance, I think, to maybe get people to do important changes. And that matters more than this current crisis, which we'll get out of one way or the other, I think. And I'd like to compare with the way we reacted to the last big financial crisis, which was in the Great Depression. We had both President Hoover and President Roosevelt were very forceful in reacting to the crisis, and I think on net they were beneficial. For example, when Roosevelt came in, within 1 week of becoming president, he abandoned the gold standard, and this is a major, major change, which freed up the Fed to do monetary policy. They were constrained before, and that was part of the reason for the Depression. He also created deposit insurance, which is a whole new institution that had never been tried on a national basis. That is now copied all over the world. And they did the SEC and the FHA, and then the Homeowners Loan Corporation, then later Fannie Mae. So my hope is that the new president that we have will do something. So my book was written for the new president, actually. But I just wanted to compare it with the G7. I remember we had this terrible market crash, October 3 through 10, and it was all over the world. We had the biggest drop since the Great Depression in a week, the biggest weekly drop. And I don't have data going back to the Great Depression, but I know that for the last 20 or 30 years, it was the biggest drop in the UK, in Japan, India, Argentina. It beat their Argentine crisis. It beat the Mexican crisis in Mexico. We had this huge crash. And so they came out with this list of goals. This is the G7 countries. And then the G20 countries rubber stamp these. But I just look at these, and they're all kind of short run. There's nothing here about any fundamental change. It's all about unfreezing something or restarting something. So I think the metaphors are wrong. They're not enlightened. And we have to I want to try to get a more enlightened plan. So let me go to the etiology of the crisis. I just wanted, this is my index. This is the S&P Composite Stock Price Index. Back to 1881. I think you need to look at a lot of data to get historical perspective. And the perspective here is that this is the boom. That's 1871, all right? This is the boom of the 1990s. That's 2000. It crashed and came up again and crashed again. And as of October 29th, we've lost half the value. Real value. This is real and corrected for inflation. This is another problem that econometricians have. This event here is almost unique in history. There's only one that really looks similar. It's on a smaller scale, but it's the same similar thing. The stock prices went up dramatically in the 1920s, peaked in 29, crashed 80% by 32. Okay, so it's kind of similar. We're down 50%, they were down 80%. A lot of similarities to that event. So the question is, should we be doing, one of the biggest problem that econometricians have is they like to use the best data, and that means 8 years of data, or, well, you're different, but most econometricians. I've had people who do seminars on real estate prices, and they use there's this thing called the Radar Logic Index, which only goes back to 2000, so it's 8 years of data. And this guy triumphantly says the expected return is 12% a year on real estate, and he's making portfolio analysis based on that. And it seems, I said, that's the bubble. You're just looking at the bubble, and I think you learned something from this big. So it's kind of tough for econometricians to figure out what's going on. And it seems to me that there's a regime change happening here. And I think that the regime change is a focusing of attention and a bubble. And so the psychologists talk about human behavior and the importance of understanding attention. There are times when we're completely preoccupied with something else, and there are other times when we're focused on the market. And when that happens, big things happen in the market, and we live in a different world. This is just the price-earnings ratio. And just to show how unusual we've been recently, this is John Campbell and I advocate, but it really goes back to Graham and Dodd, price divided by 10-year average of earnings. And this price-earnings ratio, back to 1881, shows that there's two main peaks, 29 and 2000. And they both had very disastrous consequences. As of October 29, we're really all the way back down to the historical mean. So I think that this decline was kind of predictable, contrary to the whole efficient markets theory. But that doesn't create a business for predicting the market, because it's only in these extreme cases that you can predict. Right now, I don't have much prediction for the market because we're right at the historical mean. Now this is a plot I just created showing volatility from January 1928 until 2 days ago. And what I did is I got the daily Standard & Poor Composite Stock Price Index for every day, and I computed for the last 30 days, up to including the date shown, the standard deviation of the percentage price changes. And look what's happened. We are at an enormous peak. When did we have peaks like this before? Well, this one stands out. But this is really because of one day, October 19th, 1987, when the stock market dropped 20.5% in one day with the S&P. So in order to get another one, you know what that is? That's 1929. That was a big event.
You called that you referred to the Great Depression as that event.
Yes, that event of the, well, anyway. The Great Depression was led by the Depression lasted from 29 to 41, and there was incredible volatility in the market over much of that period. So the question is, are we in this spike that's going to be isolated, or are we going to be something like this? But incidentally, this volatility to me reflects psychological factors. And just think of what people have been telling you recently that you know, and I think it's replicated over the whole world. People are saying, should I buy, should I sell? Right? I'm trying to make a decision now. There's a sense that something big is happening, so time is sped up for everyone. So, we have to change our time unit for analysis because of the focusing of it.
That's what you get on the horizontal axis. Change the time unit.
No. Oh, it's the graphing is doing something funny. But that is 28 January 13, right? 1928. Why? This is Excel. I don't know why it did that. I can't explain it. This is the Conference Board's Consumer Confidence Index, which has fallen to the lowest it's ever been as of October 2008. This series goes back to 1967. They didn't have confidence indexes in the Great Depression, but I suspect that we would find that this is the biggest drop in confidence since the Great Depression. I'm keeping making parallels with, the whole thing is, I don't mean to invalidate what you just did, Ed, but there's been a regime change. And so this is another example of regime change. I'm not criticizing, I think you're probably right on your policy prescription, but let's just look at this. This is the Treasury bill rate every day since January 4th, 1951. And you notice I stopped in September 17th. It hit 0 on September 17th. And incidentally, it went slightly negative. Okay? When did the T-bill rate last go negative? Well, I found out. It was 1938 in the Great Depression. And I found newspaper articles from 38 saying, people ask, how can interest rates be negative? And then they explained why it actually happens. And the same newspaper articles suddenly reappeared 70 years later again. So again, parallels to I think that the world is different now because of the fear of the Depression has come up. It's really being talked about in the last month. This is my home price index back to 1890, the red line. I say mine because it's really not mine. I just spliced together a different index. Well, it's case Shiller starting in 87, around here. And then before that, I spliced the BLS home purchase component. And then this is an NBER series that was produced using data that end in 34. And then I patched this gap. I wanted to get just a rough, I don't know how accurate this is, but rough idea what home prices have done in the long run. And this is what I got, and it's probably not perfect. But the amazing thing is that nobody else had ever tried to construct a long-term home price series. Again, this is my biggest criticism of econometrics. These guys are looking at short time series all the time, and you just know there are regime changes and the world changes. You can't just look at 20 or 30 years, because you were looking at 50 years. It's better. So anyway, it seems that we were in the biggest home price boom ever. Now, from the perspective of someone living in California, it doesn't seem that way, because California is the vanguard of home price bubbles. And they invented home price bubbles in California. There was a huge bubble in the 1880s in California. People find that amazing and hard to believe, because wasn't that like the cowboy and Indian days? But they were out here bubbling away, just as they are now, back then. And, but what's different is that, see, there's the California bubble, but it's averaged in with the rest of the United States. And there's another California bubble averaged in, so it doesn't look very big. Well, now what happened in this one is we all eventually learn the Californian ways, and we all get into bubble thing. Now it's everywhere, almost everywhere, and so, and it's about halfway. This is as of the second quarter. In real terms, it's almost halfway back down. Now, this is our national index. Our monthly indexes, we've got those through August now, so they're suggesting it's, if we don't have it for the whole country. Incidentally, I don't think this is explained, and this is what Chip was saying when you were talking about your research back in 1986. Fundamentals like building costs, population, or interest rates don't seem to explain it. And this is some S&P case Shiller indices. I should point out, San Francisco is this baby blue line. But San Francisco is not really so different anymore from lots of other cities. Well, some of them are more stable, like Denver, but it's becoming a national phenomenon. So now, Ed said that the bubble was blamed on the subprime mortgage loan. No reference to psychology. And maybe you said you will, but in your talk, you blamed it on some kind of institutional thing. It's true, subprime lending is part of the bubble, but is part of the causes of the situation we're in, but I think it's also a consequence of the bubble. The subprime mortgage lenders were working under the assumption that home prices were going to keep going up. And there were lots of other things happening that were, the funny thing about this bubble is that the dumbest idea got, and Chip and I have confirmed this, got common currency. And it is really dumb. Home prices only go up, right? Why would anyone think that? Especially since, here in California that they went down in the last cycle, and they've gone down in Japan. And yet, we found that there's and we found in our surveys that recently people thought home prices would go up 10% a year, median expectation during the boom in California. And that is a dumb idea, too. We said for the long run, over the next 10 years, if home prices went up 10% a year for 10 years, they'd double every 7 years. It ain't so. But this is why I think we have to understand, it's not that people are stupid. People are brilliant when they focus their attention. And the history of humanity is a history of flashes of brilliance interspersed by incredible stupidity. So we had in Nazi Germany, we had brilliant scientists, but they were designing their rockets to dump bombs on cities, that sort of thing.
That's true. From 75 to 2005, right? House prices nationally, if you look at national, never went down for a single quarter.
In 75.
In nominal terms. Never went down in a single quarter from 75 to 2005.
Well, I don't know if that's exactly true. Our index.
In our index,
I
there were
can't quarrel with that.
2 quarters. 2 quarters. This is why the part
Yeah.
of a percentage point.
Well, part of it is complacency that developed. The broader thing is the Depression was 70 years ago, and that just seems so long ago. You know, who cares? I mean, we can't believe that things like that happen again. And the thing is, we want to be precise and quantitative, and there isn't much data, and it's bad data, so we just assume it's irrelevant, and then that brings it on again. It's exactly that complacency. And a lot of these institutions were built on that complacency. So this is just my theory of bubbles from my book, Irrational Exuberance. But basically, I think of bubbles as social epidemics. So this is social psychology or sociology at work, that something gets them started, but they get amplified. And it's a little bit like influenza or a cold. It spreads from one person to another if the contagion rate is high enough, and the contagion rate gets high at certain times. And cultural factors and psychological factors make it a complex phenomenon to understand. But it's like a feedback, a price-to-price feedback as well, that operates with a different intensity at different times depending on our attention. So anyway, what do we do about this mess? First of all, I endorse what Ed said. It sounds right, the Fed should do that, but that wasn't what I was going to talk about. Short-run solutions is what is commonly discussed now, and these are bailouts. And I think that we need to do some bailouts. But unfortunately, because of we have a social compact, we have a civil society, and a lot of people are suffering for no reason, no fault of their own. But they create a moral hazard problem, and they send the wrong message. They interfere with markets. And so we should really be thinking about how to make things work better for the long term. So these are the various points that I have, and I have like 5 minutes, I think, right? 4 minutes. First of all, I think that the current crisis would have been helped if people had better information. And let me just talk about the first thing. Most people don't get financial advice. They're listening to salespeople of one sort or another. So people were put into a bad mortgage situation, and they were not hearing what Chip Case would have advised. They're hearing what a mortgage broker who gets a commission from selling the mortgage would advise. So I think we need to subsidize financial advice. It's a little bit like we live in a world as if, suppose the medical profession were organized the following way. When you get sick, you would go to a drug company and talk to a salesman, right? And they would look through their drugs and never tell you about the competitor's drugs. But that is the world we live in finance. Okay. Secondly, Dean Schill said something about the law is part of the solution. Is that what you said? I'm just listening to what lawyers say. The problem that we talk about, all of this bailouts are trying to prevent the problem from being turned over to the lawyers, right? Why did we bail out Bear Stearns? Because it would go to those lawyers and they'd mess the whole world up. And so why is there this sudden break when bankruptcy occurs that it leads to devastating national problems? Well, Jay Westbrook is a lawyer at U of Texas who says that the law has to think more like economists, and that the bankruptcy process should be changed, and that there should be a representative of the public interest at a major. There should be a triage that identifies serious systemic bankruptcies, and the bankruptcy process might be sped up or slowed down in different of its aspects depending on the circumstances. So he said that we should look at what the stock exchanges do with their circuit breakers. Sometimes they slow the market down, and maybe a bankruptcy process might sometimes slow the market down. Luigi Zingalis has a proposal now for accelerated Chapter 11 bankruptcies. Quickie, what do you call it? Like quickie divorces, there's quickie bankruptcies now. Secondly, I think we should have broader markets. This crisis was caused by a failure to manage risks, notably real estate risks, and all these different people had balance sheets exposed to the risk, notably households. And it's this really bad advice they've been getting that you should buy your own home and you should leverage it up with a mortgage, and that should be your life saving. Well, that isn't exactly the advice, but that's how a lot of people heard it. Well, that's a really dumb idea, too, I think, because you find yourself, I know Chris will disagree with me on that maybe, but okay, I won't say it's a dumb idea. But it doesn't sound right. People should be investing in a diversified portfolio. So we need to, so this is the futures market that Chip and I were involved in creating at the Chicago Mercantile Exchange. And I'll show, that's the east cities, and here's the west cities. And so let me, this is the, unfortunately it's not taking off. It's there, but it's very slow volume. And we're trying to think about how to get more capital into it. My first thing is the government is just giving $25 billion of capital to a bunch of banks who've got us into this mess. Just $1 billion capital would get this market going. Unfortunately, it's not very liquid now. But I just want to emphasize what you've got here. This is trading today, and I've got San Francisco plotted as the green line. So this is as of October 14th. The market is predicting further declines. This is not me, this is the market. In San Francisco home prices of, what does that say? Something like 16%. I'm trying to read from the chart. And so what this means is you can lock it in today. Are you lying awake nights worrying about the further price declines of your home? I shouldn't put it quite like this. I am not a salesman for this contract. And I really seriously have to say, you should talk with your financial advisor. But I can tell you what hypothetically you could do after you talk to your advisor. And that is, you could lock in this price decline right now so that your home will go down another 15% in value, but no more. What's inhibiting this market is people look at this and they think, well, what if it doesn't go down 15%? Well, then you still lose it. See, that's the thing about financial markets. If you hedge it, you're hedging it at the market price, and that's where it is. This market is saying a 15% decline. And we're having a little problem getting people psyched to think that way. But that's what, well, anyway, I won't say what you should do.
Sell portfolio insurance instead.
Portfolio insurance was an interesting, that was some UC Berkeley economists.
Bob, we got to end that.
Okay, and so we also have, we're trying to do something like it on the New York Stock Exchange later this year. And then final thing is retail products. We have, I'm proposing, not we, this is in my book, that we should have continuous workout mortgages. And that means mortgages that have a workout built into them. Now, a big part of this problem is that mortgage servicers can't do workouts because they're tied up. They don't have a contractual basis for doing it, and they could get sued by some of these people owning the tranches and the securitized mortgages for doing something that's not written down. And I want the mortgages workout to be done on a systematic, continuous, automatic basis, planned in advance. It doesn't penalize people who are honor bound to pay their mortgages. It doesn't benefit particularly those who go begging for it, who say they can't pay. And I just think it would create a much smoother and better response. So finally, this is all about democratization of finance. I said at the beginning, finance theory says that what matters are the individual people and their utility. And so if we let finance theory speak, we will be democratizing finance. We will be making the institutions work for more and more people. And I have a new website, financialdemocracy.org, where you can send your comments. Okay.
Thanks. Bob, do you want to come up? And Brad, do you want to go first, too? Do we have the order in the, it starts with Brad DeLong, who...
No, I'm not going to. Well, why don't I just talk from here?
Okay.
Now, in Ed Leamer's formulation, our 11 recessions since World War II 4, I am highly confident that Robert Hall and his business cycle dating colleagues will someday declare that the economy peaked in the fourth quarter of 2007 and has since been in a recession. Consist of 1 sharp reduction in defense spending.
I promise it within the next year.
Okay, yes. 1 comeuppance after the end of a high-tech bubble, 8 housing and consumer-driven recessions, and today. Ed wants to be a macroeconomic time series econometrician and use the patterns of previous housing and consumer-driven recessions to analyze what is going on, a tradition of intellectual inquiry dating back to David Hume, who said that if the sun rises in the morning every day of your life, you can be pretty confident that the sun will rise again. And by looking at the past patterns of when and how the sun rises, you can kind of figure out where the sun's going to be. Unfortunately, in time series econometrics, it's not astronomy. Time series econometrics is a brave, a bold, and I think a foolhardy exercise at the macroeconomic level, a task I wouldn't wish on a mangy dog, especially now. For it seems to me that what's going on now is not only not like the post-Korean War defense build-down structural adjustment, and not only like the post-2000 structural adjustment and sectoral shift out of high-tech and into housing, but also not like the previous 8 housing and durable-led recessions we have seen since World War II. You see, those 8 other previous post-World War II recessions, I think they have their origins in the big conference room of the Eccles building on the Mall in Washington, D.C., and the impulse is that in each case, at some moment, the 19 voting and non-voting members of the Federal Reserve Open Market Committee say, "Oh, blank, inflation is too high. We can't let this go on. We have to." And then the Keynesian members of the FOMC say, "We have to raise interest rates." And the monetarist members say, "We have to stop interfering with the natural, normal free market processes that would have pushed interest rates up by now." Basically, the Federal Reserve fights inflation by attempting to create deficient demand, by using high interest rates as a brick with which to hit the housing sector primarily on the head, and also credit-financed consumer durables as well. Hit the housing sector and credit-financed consumer durables on the head with higher interest rates. Demand shrinks, production shrinks, employment shrinks, income shrinks, until there's enough deficient demand in the system that businesses stop raising prices, at which point the people in the conference room of the Eccles building say, "Oops, we've done enough," or "Oops, we've done more than enough," or "Oops, we just bankrupted Mexico." And lower interest rates and housing and credit finance consumer durables bounce back. Now, that doesn't seem to be what's happening now. Something different seems to be happening. The Federal Reserve did not pick up the high interest rate brick and hit the housing sector on the head with it this time. Instead, Wall Street has done something bad. And do patterns derived from looking back at historical events that are not quite like what's going on now and key features provide a useful guide? That's a question. I don't know. I do know that Ed Leamer is very smart and very brave to be a macroeconomic time series econometrician in this environment. But it's not clear what macroeconomic time series econometrics has to offer us right now. This isn't an answer-focused discussion, as you may be aware. Robert Shiller wants to step back and talk about long-run considerations for policy. And we look to him because he is one of our intellectual leaders in what is now a consensus among economists that we need to reject the theory of economic policy that I like to call Greenspanism. Greenspanism is the doctrine that the Federal Reserve must first make sure that consumer price inflation stays low, and second, make sure that expectations of future consumer price expectations stay low, but that otherwise it should let the macroeconomy govern itself. And if financial or technological exuberance leads to an episode in which the economy is saying laissez les bon temps brûler, then laissez les bon temps brûler. If the exuberance turns out to be irrational, and if a big crash does come, And if the risk that crashes is not properly diversified, but is instead held unhedged by highly leveraged financial institutions, and if they then go belly up, well, the central bank and the Treasury have the tools to clean up the mess. Better to clean up the mess afterwards than to anticipatorily hit the economy on the head with a brick and cause high unemployment and lots of business bankruptcies just because you fear that a boom will turn into a bubble that will generate a crash in which you'll find risk was not properly hedged and your big financial institutions will go belly up and the market will not work it out by itself and you have a problem. Better to not shoot the goose that's laying the golden eggs, at least not while it's still cackling. Nowadays, there are very few Greenspanists. Indeed, Alan Greenspan is no longer a Greenspanist himself. I relied, he said the week before last, testifying before Congress, on the self-interest of financial sector professionals to keep their risks properly managed and their organizations properly hedged, and I was wrong. And properly hedged, we shouldn't have a problem. There are now, $2 trillion of mortgage security losses kind of lurking out there in people's portfolios. But there are now $70 trillion of financial assets, or there were $70 trillion in financial assets on October, 2007. There now are about 60 trillion of financial assets in the global economy. A 3% decline in aggregate asset values because of the collapse of one particular relatively narrow asset class, most of it focused on people making high loan-to-value mortgages on new houses in the desert outside Los Angeles, in Florida, and in the very high pricey sectors of the East Coast, should not produce a big macroeconomic crash if financial institutions are properly hedged and if risks are properly managed, yet it has. So there are no Greenspanists now. And if there are none of us Greenspanists now, what should we do? Both in the short term now and in the long term, in the way of institution design. And that's what Robert Shiller is kind of groping his way forward toward in this paper. And I'm afraid that I have to stand up here and say that, Bob, I can't help you. I also have no answers. That is also a question. I do know that in the long run, we need to have people like Bob Shiller thinking very, very hard about behavioral and incentive issues and in how we have failed. How we have failed both to educate American consumers and households as to the proper mode of long-term financial decision-making, and also how we have failed to properly police, say, compensation in our financial system. If you were working for an investment bank in the 1920s and you were relatively junior, you had a very good deal, but you were part of a partnership. You knew that 5 years from now, or 10 years from now, or 15, your seniors would sell their stakes in the partnership back to the partnership at par, and you would become a senior and you would rake it in, even during the roaring 20s. Thus, you had an enormous incentive to make sure that your organization was properly hedged. And indeed, when the great crash comes, only one of the big investment banks goes belly up. Goldman Sachs goes belly up because of the Goldman Sachs Trading Company. The rest, the major commercial and investment banks, they don't go belly up, or at least they don't go belly up until the whole economy has gone belly up. And not just one small asset class, but every asset class that is collateralized at all finds the value of its industrial or commercial or real estate collateral greatly impaired. The fact that we have a huge financial crash with not yet a major real economic depression indicates that in some ways we've been a lot dumber than our predecessors back in the 1920s. That back then they made financiers and high corporate executives long the value of the institutions they worked for. It seems that today, with our options and our immediate cash payouts and our 2 and 20, what we have done is we have made We have made our financial professionals and our CEOs long the volatility of their organizations rather than long the organizations, and that's a big mistake. But aside from those two remarks, that we need to worry seriously about Schiller-like behavioral finance and education, and we need to, say, prohibit anyone earning over $500,000 a year from taking any of their money in the form of cash, that it all must be in restricted stock in the institution for which they work, which they cannot sell for at least a decade, to properly tie them to the mast of the ship as a whole. And if they don't do that, we can impose a 100% tax rate on the excess. Aside from that, I have no question. I have no answers. I just have questions. I do know that I don't quite trust Henry Paulson anymore, that his career means his thinking is too closely aligned to that of our current investment banking industry, with which I think we have a few reasons for discontent right now. And his Republican ideology means that he cannot even think of adopting policies that involve a substantial government role without breaking out in hives. And this may be a time when we need to have the government stepping in some way. I do, however, trust Ben Bernanke. His academic career seems to have been an ideal preparation for dealing with the worst financial crisis since the Great Depression. And he has an enormous and excellent staff.
Well, pleasure to be here. I met both of the authors in the same year, 1970, when I came to MIT. Right here. Yeah, sorry, the sound systems. There we go. Okay. So I met Bob and Ed both in the fall of 1970 when I came to MIT to teach. Bob was then a, I don't know, 22, 23-year-old graduate student, and believe it or not, he was quite boyish in those days. So now he looks about 30. Then he must have looked about 12. And he came to me with such a completely sensational idea, now published a couple years later in Econometrica, back when he was, you know, a hardcore econometrician, less of a skeptic in those days. And of course, Leamer was Leamer. Leamer hasn't changed a bit since those days. I won't say anything more about that. But it was a pleasure to be affiliated with both of them. I'm going to start by doing something that I think is derived from my role in keeping track of the business cycle, which is to look at where we are now and try to relate that to what's happened in terms of financial events. And there's a bit of a strain in this that things aren't so bad as you'd read. It's just remarkable. Today, the real output of goods and services in the U.S. economy is 7 basis points below its all-time historical high. You'd never learn that by reading any media coverage you'd think that the economy was flat on its back, consumers are spending nothing. But, you know, consumption, again, is just very, very close to its all-time historical high. Now, I'm not going to forecast, and, you know, I join those who are concerned, gravely concerned about what's happening in the future, but let me just take you through some numbers here. And first of all, since I want to relate this to the concept of that there has been some kind of financial crisis, here's one metric, the U.S. interbank lending rate, which is the effective federal funds rate, as a premium spread over the 3-month Treasury bill rate. And I think for domestic purposes, this is an interesting indicator. Now, one thing that's very important to understand as I go through all these numbers is everything I'm telling you about is an economy that has responded to the enormous amount of effort that the federal government has put into heading off financial disaster. Okay, so in particular, notice that the domestic spread, unlike the LIBOR spread, which is at an all-time high, or was an all-time high in October, responded much less to the October crisis than it did to the spring crisis. Why is that? It's because the Federal Reserve and the Treasury have done so many things. So we're looking at an economy net of the federal government's response. And everything I talk about is, it's not saying that there wasn't an incipient disaster. It's saying that so far we've been protected from a disaster by response. Now, I don't necessarily agree with the nature of all that response, but there was a very aggressive response, and I think that probably was a very good thing. All right, so this picture is going to appear at the bottom of each of the further slides. Okay, so there's been a huge amount of discussion about the collapse of consumption. So what are the facts about consumption? The facts are that the collapse was entirely restricted to two categories that Ed mentioned, and that is cars and furniture. In other words, it's a very focused decline for which we can assign a very obvious reason. And interestingly, that reason has nothing to do with the financial crisis, has everything to do, in the case of cars, with the increase in the price of gasoline. In furniture, it's obviously related to the complete collapse, which I'll show in a second, in new house construction, since furniture is closely related historically to housing construction. When you look at non-durables and services, so far, and this is, except for, I didn't get the data this morning, the new monthly data came out this morning, but as of yesterday, when I put this together, there's just no sign of any collapse of consumption. The notion that at the moment the consumer is just not spending anything more is crazy. That's just not reality. Reality is that purchases of services and non-durables are right on the growth track. What has declined and what's made total consumption decline is strictly these identifiable components, furniture and cars. That's so far what's happened. The theme of one of these remarks is going to be that so far, what's happened in the U.S. economy is we've seen a devastating collapse in housing construction, a major decline in car purchases, but enough else going on in the economy that the output of goods and services in this economy is only 7 basis points below its all-time historical high. Okay, so with respect to cars, which are an important part of this story, you can see that there's a definite relationship between car loan interest rates and the measure of financial stress, the interbank spread. And that's certainly a later contributing factor to the decline in car purchases. But the collapse of car purchases began long before the financial crisis. It had multiple contributions. And the same thing's true of housing, of course. Okay, so here's by far the most important event. The decline on the U.S. economy in terms of spending has been very concentrated in residential investment, no surprise. Notice, however, that it's not particularly related to this measure of financial stress. Now, this is a quarterly number, so the figures look a little different. Residential investment has been an unbelievably steep decline for a long time, even during a period of financial quiescence. So we want to be very clear that the financial crisis didn't cause the decline in residential investment. Rather, causality clearly runs in the opposite direction. That is, residential investment collapsed caused a decline in values of securities, which then resulted in this crisis. Okay, so again, you see the same thing in mortgage spreads. So there's been a later contribution in that there's been a remarkable, we talked a lot about this yesterday, remarkable increase in mortgage interest rate spreads, especially affecting California, especially affecting jumbo mortgages, which are a big part of the story in California. Okay, what about other components of spending? So here's plant and equipment investment. If you read any newspaper in the United States, any financial section, you'd believe that plant and equipment investment had fallen in half because no business has any access to credit anymore in the U.S. economy. But that's just not true. One could imagine that it would be true, but finding a response to the collapse of credit markets measured by the spread, the bottom of this picture, and actual plant and equipment investment so far is pretty much on a growth track. Now, again, this is not a forecast, but I think it's very important to understand that the U.S. economy, unlike all other advanced economies, is not very dependent on credit. The U.S. corporate sector, financial and non-financial together, has negative leverage. It owns more bond claims than it issues. That means that sector is not very sensitive to credit. And that makes the U.S. economy very different from every other economy, which is typically businesses are very bank dependent. And that may well result in the fact that this oncoming recession, which seems obvious, I have to say that softly though, because we haven't said it yet, may well be worse, and already is worse in Britain, for example. In Britain, the decline in GDP has already been substantial, not true in the U.S. And that's because that's a much more bank dependent. So the spending there is much more sensitive to credit than it is in the U.S. Okay, net exports. This has been remarked upon a lot. We think that, and the collapse of other economies that we trade with may well result in some turnaround, but there's been just a remarkable increase in net exports. A lot of that is that car spending is down. Lots of cars are imported. Net exports rises when imports falls. So don't think of this as just the export side. It's also very much the import side. Notice the numbers are negative, so our imports exceed our exports. No sign there so far of any relationship to the financial crisis. Okay, so that's just a quick picture. Again, there's no forecast, and again, I want to stress that this is an economy which may well have been saved from catastrophe by actions that have been taken over the past year by government agencies. Okay, now what about policy? I think obviously there's lots of room for policy improvements. Unlike others, I'm of course a free market economist at what's-its-name university. And so, I can't help thinking that we really do need to preserve the concept that has been labeled Greenspanism. Brad, who's very good at this sort of thing, has come up with that concept, and that what in a legal setting you might call private ordering. And we used to think that was really an important idea, and I still do. But we've got to get it right. The problem in this economy and every other advanced economy has been the development of financial institutions that enjoyed explicit or implicit guarantees from the central government, who then responded to that by leveraging their activities to completely irresponsible levels. And that was possible because they enjoyed this guarantee. They were sufficiently creditworthy to be able to borrow to the point of extreme leverage and extreme sensitivity to fluctuations in asset prices because they enjoyed the belief that the government would bail them out. Well, we cannot allow that. And we have a perfectly well-developed institution, which was a big success in the US for commercial banks, namely capital requirements. We don't need some complicated system of regulation. We just need capital requirements that are substantial and enforced. So there's a very simple solution to this problem, I think. And you can see that major commercial banks, which had substantial and enforced capital requirements, not big enough, and the enforcement's not enough as far as I'm concerned, but commercial banks actually have survived quite well to this point. Again, I'm not forecasting, but well to this point. But I think another thing, and this is certainly where Bob Shiller got this research started, the most important principle that everybody in this room and everywhere who's thinking about this subject should know is Campbell-Shiller. Okay, so Campbell-Shiller teaches you the one thing you really need to know about policy in this area. And what's that? It's that if some ratio of a capitalization price, like the stock market price or the price of real estate, to some underlying flow, such as earnings or rentals or income, if that ratio has reached an unusually high level, the price is going to decline sooner or later. That's Campbell-Shiller. That's the most important finding in finance of the last century, Campbell-Shiller. I tried to teach everybody that. And what does that say? It says that policymakers ought to pay attention to those ratios, the Campbell-Shiller ratios, and they ought to get really nervous. In particular, they should raise capital requirements if price earnings and particularly in real estate, if the price rental or the price income ratio gets out of hand, which it totally did. So the Campbell-Shiller analysis applied to real estate is even more powerful and even more important for policymakers. How much more time do I have, Chip? A couple minutes. Okay. So I haven't said much about Ed's very interesting, but I think, how shall I say, unusual paper. So I want to defend what's become traditional monetary policy. I'm afraid that there's a real cycle, intellectual cycle that's taking place here, and Ed is a newcomer to this, and he doesn't understand how much we went through to try to get central bankers to understand what it takes to stabilize inflation. Well, we had this worldwide success in stabilizing inflation, unbelievable success, and it saved us a huge amount of grief. But now we have the Leamers coming in saying, oh, well, inflation, that's no problem at all. I mean, the inflation, there hasn't been any inflation anywhere in the world that matters for 2 decades, so we can forget it. And now we can assign all other kinds of tasks to the central bank using its interest rate control instrument. But I think it's really, really important to understand that instrument belongs to one target only, and that's inflation. Now, I agree that the central bank and other policymakers, obviously the Treasury, should be paying attention to incipient financial collapse measured by Campbell-Shiller type ratios. I totally agree with that. But it's not the central bank that ought to be using its interest rate target to do that. It should be other tools. Capital requirements, more than anything else, capital requirements, that's what it takes. So what we need to do is teach Ed some more monetary policy history and preserve the value of something we've achieved, which is inflation stabilization, and then use other instruments guided by things like housing starts, which I agree with, but more than anything else, the Campbell-Shiller ratios, and head off the disasters that we've had in the past and that we're having today by using other tools, capital requirements. So let's get going with capital requirements. Thanks.
I'm just going to take user. I'm going to steal 30 seconds, and that is, in the summer of 2003, Campbell-Shiller was out of control. Prices were going up like crazy, and yet we had another year of 1% interest rates, expanding.
For essential reasons. That was the period when we were gravely concerned about the possibility of deflation and the possibility of the U.S. economy going into a deflationary spiral from which monetary policy has a great deal of trouble recovering.
So how do you trade those two off? You see this
capital requirements. Capital requirements. It's very simple. It says, okay, we're going to have a problem. We're going to enter another cycle. We cannot afford to become Japan. We cannot afford to become a deflationary economy where monetary policy has lost all its control. I mean, that was what everyone was worried about during that period, believe me. And we did the right thing. We expanded the economy. We narrowly escaped that, but we did escape it, and we did it with low interest rates. Low interest rates in 2003 were essential for proper monetary policy. So we need capital requirements to deal with the potential fluctuations.
But there were capital requirements. So FAO had capital requirements and stress tests on Fannie and Freddie.
Yeah, what, 1.5%? That's not an appropriate capital requirement for an institution that is exposed to the known volatility of you know, if anyone who read Schiller's long-term measures of real estate prices would never have assigned such a low capital requirement to the GSEs.
Okay. Jim, we got to get going. Sorry.
Okay.
No, that's no. It's going to be Wilcox. I presume.
You want to walk in at 10:30?
Yeah, he's said it, yes.
So we'll be walking at 10:30. Okay.
We're okay. If it's 5 minutes after, it's
Okay.
Okay, thank you, Chip. I wanted to thank Stuart and John for giving me a chance to be on your program here today. I want to start out talking about Ed's paper. Ed makes a pretty strong case that housing's been a leading indicator, and so have a number of other consumer spending categories. He provides an enormous amount of detail and analyses of the timing of the components around the last 10 recessions. He talks about the false negatives and false positives, but mostly the great hit rate of housing and consumer durables. And eventually, he proposes the Leamer rule. And the Leamer rule would tailor the Fed's rule to set the funds rate in a way to stabilize housing starts. I guess I wouldn't be very surprised, based on history, that housing bore such a close relationship to recessions, in part because it bears such a close relationship to monetary policy, both due to the interest sensitivity of housing demand, accelerator effects, and also financial disintermediation effects that we've had historically, but maybe not so much recently. And in fact, it's a little surprising, I think, to have this kind of a proposal at this point. It would have been even more persuasive, I think, before we'd had so much financial deregulation, before we'd had so many new mortgage instruments and development of secondary markets in housing, after interest rate decontrol and so on and so forth. And I'll try to make that case as we go along. So what I'll do is to do a few regressions, somewhat in the spirit of what Ed has done, and despite Brad's warnings. So what I want to do is forecast GDP. And in particular, I'll call the GDP gap the spread between real GDP and potential. So we'll look at numbers like at full capacity of say, being 100%. We use quarterly data, and we'll include lags of lots of things, but in particular, we'll have the core inflation rate, the GDP gap, the federal funds rate, and we'll look at residential investment to see how that does. And then the first alternative candidate and the last alternative candidate I want to show you some data for is the index of leading indicators. Ed suggests that what we need is the Fed to be more forward-looking, and my suggestion is going to be something that's quite forward-looking, is the index of leading indicators. So what we want to do is look at some forecasts, both at really short horizons of the sort that Ed had talked about in his paper a bit, 1 quarter ahead and also 4 quarters ahead. And then I do want to use some different estimation periods, partly because presumably the world has changed. Instead of looking at 60 years of post-war data, I want to start some of these samples, say, in the 60s, 70s, 80s, and even in the 90s. So suppose, first of all, we're going to actually include a housing variable, the residential investment, as a share of potential GDP, as well as leading indicators here. And so if you look at the F statistics columns here, columns 1 and 2, what you have are the F statistics for the restriction that would exclude the 4 lags, either of housing, I'll call it, residential investment, or the index of leading indicators, ILI. As you can see here, there's a lot of asterisks. Both variables tend to add significantly statistically to forecasting 1 quarter ahead GDP gaps here. But notice when the sample period starts more recently, when it starts, say, in the 80s or in the 90s, in the bottom couple of rows, though the index of leading economic indicators still helps you forecast, housing doesn't. And in part, I think this is because of financial deregulation and because of the maturation of secondary mortgage markets and other sorts of markets connected to housing. In the other columns, what we have is a change in R squared, which is going to be a similar transformation. And there, what you can see in the bottom right corners, in the bottom rows there, is that, in fact, the index of leading indicators actually tends to add somewhat more than does residential investment if you're trying to forecast GDP. Then what I'd like to do is a horse race. And the horse race will alternately try housing or the leading indicators as a way to forecast GDP 1 quarter ahead. And then we'll do the out of sample. So these are all going to be estimated up through the end of 2005. And then we'll have a sequence of 1 quarter ahead forecasts to see whether, in fact, you'd do better if you were going to choose between using housing or use the index of leading economic indicators here. So if you look in the columns on the left here, what you'll see is that in general, the root mean squared error, the forecast errors, tend to be smaller if you use the index of leading indicators than by using the housing variable. And it's more pronounced in the very last sample period here, the sample period that begins in 1990. So these would be sample periods that begin in 1990 and end just 15 years later in 2005. A picture of these results is here. The solid line is actual GDP, the actual GDP gap. And then the pink-colored line is the forecast you would have gotten out of sample with a sequence of 1 quarter ahead forecasts by relying on the index of leading indicators, in contrast to using the housing-based forecast, which is the slightly green dotted line that's up above there. So in fact, even in the current circumstance, we would have done better forecasting the GDP gap by using the index of leading indicators, the 10 variables that are used to construct that index, than by using the sole variable of residential investment. I think one thing this also notes, or points out to me at least, is with this GDP gap measure, I think reinforces my view that we pay too much attention to recessions. You notice that the gap number is basically at 100, that is basically no gap in early 2006, but actually the gap has been growing ever since. And so though there are various reasons we might want to pay attention to when the absolute level of real GDP declines, that has its own independent interest. It seems to me at the same time, if we want to talk about the strength of the economy or how much the economy is underperforming, we ought to also look at the gap, or sometimes what used to be referred to as growth recessions as well. And by that measure, we've been in a slumping economy for at least a couple of years. The out-of-sample forecasts based on the simple, based on the shorter period are then given in this following slide. And here you can see where, again, where the actual number is given by the solid blue line, it's traced more closely by the independent or leading indicators measure, the pink one, as opposed to the housing measure. Not surprisingly, the housing, since housing, as Bob just showed, since housing investment has fallen so precipitously, that would have forecast that GDP was going to fall much more precipitously than it actually did. We can also do a similar set of calculations at a 4-quarter horizon, not just at a 1-quarter horizon, and the results are broadly similar, but in fairness, I think I should mention that in this case, somewhat surprisingly to me, the residential investment, the housing numbers actually are significant more so in the more recent shorter sample period, given in the bottom rows, than they are in the top rows. Nonetheless, even when housing is there, the index of leading indicators is always present. And in general, you get a bigger boost to your R squared, as shown in the columns on the right, if you were to use, if you were to use indicators. And so let me switch to a forecast here. If we were to switch to an out-of-sample 4-quarter forecast, then the actual GDP gap is given by the solid line. And here, on average, the index, the forecast generated by the index of leading indicators is closer than given by the precipitous decline forecast by housing. So I would say, in general, there are any number of candidates one might think about in putting in a Leamer rule. Ed is in favor, of course, of housing starts. For my rule and for my money, I think I would go with the index of leading indicators if I was going to choose only one. I think if the Fed doesn't do sectors, what they do is signals. And I think the index of leading indicators is going to be a pretty reliable signal in that regard. Bob has an entirely different paper, of course, and he talks a lot about how to reduce systemic risks. And mostly he says, in the short run, the panic that we've had gives us a great opportunity for some long-run reforms. One of the reforms he talks about has to do with new kinds of mortgages. As we've talked about here yesterday, mortgage restructuring is apparently very difficult. It's time-consuming, it's explicitly costly, it's implicitly costly. It seems to be especially difficult, I guess, for securitized mortgages, as we've heard, but it also seems to be pretty costly and time-consuming even for non-securitized mortgages, as we heard from Brad Blackwell, I think at Wells Fargo yesterday here. In addition, I think one thing that hasn't been recognized is I think there's a lot of restructuring being delayed now for 2 reasons. One is, if I really thought my house price was going down another 10%, I would not be eager now to get a restructured mortgage. I would wait until the house price went down 10% more and then talk to the bank about restructuring. And secondly, I might even wait for an election that would bring a new set of policies that would bring me an even better deal than is already on the table. So I think for both reasons, that's one reason we've seen some delay here. Those, of course, are also reasons why perhaps institutions should be more interested in restructuring, but it's the reason the homeowners might be hesitant at this point. Bob proposes a so-called continuous workout mortgage, and the idea is the balance on these mortgages is going to decline as the area's house prices fall. Not the individual, but the area house prices. And presumably you could get a price index from something like Zillow or maybe some other kind of house price supplier. And these payments then would rise and fall monthly with the house prices in your area. And so the marketing message might go something like, your mortgage melts down with the market. Such a mortgage, the larger the response of the balance to house prices, of course, it would in fact provide some equity insurance, as it were, for the homeowner. But of course, it does increase the risk of payment shock. If you really do get a house prices moving up sharply relative to your income, there is going to be payment shock. And there's just a simple calculation there in the bottom row. So Bob has proposed a meltdown mortgage, I would say. And this could have some effects on mortgage rates. I think one of the things that has been surprising is in our current mortgages, how difficult it has been to restructure. And Bob, I think, does rightly point out that we might all be better off with an institutional arrangement that allows for more automatic and certainly less costly and time-consuming workouts. And so far, what we've, I think, been really disappointed on that count. But what's not clear is in the particular case is though this might be a good plan for the future, it might be a good idea to institute these mortgages now, it's not clear at all how they're going to help in the current circumstance. The current circumstance almost certainly is going to require contributions from homeowners, from lenders, and no doubt from the public purse. As we go forward from here. And with that, I think I'm out of time.
Now, if we can move real quick at 10:35, we've got 15 minutes. So I think there's some people out there who are eager, like Tony Downs. Yeah, microphone, here it comes.
One of the things that none of the speakers have mentioned is that the low interest rates after 2000 were, in my opinion, heavily influenced by inflows of capital from all around the world. I think globalization has not been really discussed as a factor influencing the whole rise in real estate prices, not only in the United States, but in all the major developed countries of the world except Japan and Germany. And even if Alan Greenspan hadn't kept the interest rate at 1%, I think the tremendous inflow of capital would have driven interest rates down, whatever he did. Now, he may have prolonged it a little bit by keeping it at 1% for a long period of time. But when you talk about a regime change, I think the regime change is globalization, which has made the Federal Reserve's control over what happens to the money supply is much weakened by the possibility of all this capital flowing in from outside the country, from people who are not subject to Federal Reserve controls. And yet none of the speakers have mentioned that as a factor. I think it's a very important factor.
Anybody want to comment on that? Sure. Bob?
Well, I mean, first of all, we ought to be clear that the Federal Reserve literally pegs the federal funds rate, which is a key short-term interest rate. And that in normal times, because the spreads are very small, means that they peg all short-term rates, like the Treasury bill rate, and the commercial paper rate and other similar rates. So the Fed controls interest rates. It doesn't matter what's happening in China. The Fed can pick the interest rate. Now, you're right, of course, that other, for example, longer-term rates are subject to other market forces. They're not strictly linked by what the Fed does.
They're not linked at all.
No, that's not true either, but that's a complicated, that gets into inflation expectations. They're linked via inflation expectations. And so everything the Fed does in the short term gets into the, say, the long bond market through the fact that long bonds are nominal, and so you have to worry about the inflation expectations.
We could
That's a complicated subject.
We could debate this for a long time.
Yeah,
Let's take
exactly.
a couple more, and then I'll go to Chris next. Go ahead.
So another question would be the decline in real wages, and what is that? What is the effect of that on this meltdown?
That's lowered construction costs. That doesn't explain the boom. I mean, it's been a very steady thing. The biggest component of construction costs is labor.
But you're talking about affordability. Incomes are lower, not
Yes,
growing as
in terms of
rapidly, and therefore that should put a brake on
Being
home
able to
prices.
pay the mortgage.
It doesn't explain the boom and bust, though.
It's also, I think it's very important to understand that it's not accompanied by similar change in family income. The decline, the relation of real wages to income involves some complicated demographic issues, but the purchasing power of families with respect to being able to buy houses grew rapidly relative to real wages. That's one factor in increasing the demand for housing and explaining the bubble.
Could I make a comment on this interest rate question too? Because the teaser rates really came from Washington, D.C. These short-term ARMs are written off the 3-month or the sometimes the 1-year treasuries, and without the extremely low interest rates that came, I don't think from a sensible anti-deflation pursuit, but what I prefer to call deflation dread disorder, that really got these housing market completely out of control. And as far as the Fed targeting inflation, of course I want the Fed to target inflation, but the presumption of what I was presenting today is that that inflation is very persistent. That's something that you do learn from time series analysis, by the way.
That's only because of course it's persistent. The Fed makes it persistent.
And therefore that the volatile movements of the Fed funds rate should not be dependent on inflation. I just don't think the 50 basis point cut that we had this week has anything to do with inflation. Surely the Fed is trying to help out the real economy, as they should, as they should.
But there is no doubt that after 2001, there was a tremendous volume of cash that flowed to one specific asset, housing, and the volumes are unbelievable. We did $1 trillion in refinancing in 1 quarter, and we did overall $14 trillion worth of mortgage paper. 14 trillion. That's more than the stock by about 30%. And if you look at it, if you look at that pattern and you juxtapose it to house prices and everything else, all the things that everybody said fit into that 3-year period that just created a bomb, and it's going off. Chris.
You turned it off.
On? Okay. 2 quick things. The first is the paper I'm giving early this afternoon will say a lot about real interest rates, because I think real long-term rates are a much, much bigger factor in what happened both U.S. and globally than anybody would otherwise give credit for, and certainly in countries with very, very different financial systems. The second is just, if you sort of think about in highlighting Tony's point, if you were just to plot home equity extractions on the U.S. current account surplus, you would be shocked at how closely correlated those 2 factors are. You might say that those things are, that there's an embedded relationship between the 2, but there's very, very strong relationship between those factors. So thinking about the U.S. in the context of what's happening around the world is a pretty important factor. The other thing I would say is, if you've ever tried to find a correlation between house prices and short-term rates, you would be really hard-pressed to do it. But it's very easy to find a correlation with long-term rates looking across markets. And so the issue of what the Federal Reserve did, I think, had a lot of effects on the economy, but pumping up the housing market, I don't think is the place to find it. In prices, construction is, of course, a completely different story.
Even if you look at the low end between 2001 and 2005?
The peak of use of ARMs was 1994, when over 60% of mortgages in the United States were adjustable rate mortgages. It wasn't in this cycle. So this whole discussion about kind of short-term rates pushing up house prices, et cetera, that doesn't show up. That certainly doesn't show up in U.S. data. And the use of arms in this downturn. I'm not saying option arms were a great thing in any way, but just when one looks at the data, that's what you see.
You and I usually see the world through the same set of eyes, and I disagree with you on that. I think there's ample evidence to the contrary. Yeah, in the back.
To discuss the what I'll call the Leamer Hall rule, which is to raise capital requirements when the housing prices or housing starts or something are getting really excited, which seems like a really fantastic idea, and I wish we'd done that. But Professor Hall, as a free market economist, you're supposed to think about all the ways people will engage in regulatory arbitrage to get around capital requirements.
That's a good point.
And why would this work more than 5 years? I really like the idea, but I'm just saying, how can you make it work in a world of incredible financial innovation?
Well, we do have a very successful economy, right? We have achieved a higher level of income ever known before in any other country or any other time. And we do that with a reasonably effective government. It's true that what the government does is not perfect, and certainly recent events amply illustrate that. But I don't think that that's really a barrier to a government thinking seriously about how to impose capital requirements, and how to take a consistent stand on who enjoys the guarantee and therefore who requires capital requirements. But we do have some very effective government agencies. As a free market economist, I don't buy into this notion that the government is utterly and completely incompetent. The government has some remarkable areas of incompetence, one of which is the Office of Thrift Supervision these days, but and the post office, but it has some very good agencies too. And we just need, as citizens, we just need to press very hard for the government to be as smart as the people who are trying to arbitrage around the government. And to some extent we do that. I mean, we have some extremely good people in the government right now.
I'd like to add to that what you're calling my rule. I'm emphasizing volumes, not prices, because I do think it's pretty hard to know whether prices are too high or not, particularly in an environment where real interest rates have fallen. So you don't know how much of that rise in home prices is attributed to lower real rates of interest and how much is some kind of bubble phenomenon. But if you look at the historical record, houses, when they're at 2 million units, that's way high, and they're for sure or very likely to come down, except if this new way of originating loans and the low real interest rates are opening up home ownership to a whole new class of buyers where we're going from 65 to 69%. If that's the case, then we have to have a temporary surge of building to build all the homes for that extra 3 or 4%, in which case maybe the 2 million wasn't bad. So even that is an ambiguous bubble.
We used to rent. All we have to do is change rent. We don't need to build anymore.
Yeah, I agree with that.
We'll take Susan Wachter, and then we've got to head over to the other venue.
So there has been some discussion of Campbell, Shiller, and looking at whether there are bubbles and perhaps then upping the capital requirements. But actually implementing that is rather difficult because there are fundamental shifts in prices, the shifts in the fundamental drivers of prices. So this episode, for example, there was discussion of supply and elasticity increasing in some parts of the United States in a structural way. How would you go about actually determining, looking at rents doesn't do it exactly either, rent-price ratios doesn't do it exactly either, because if fundamental expected price appreciation shifts, so should that ratio.
Okay, well, one thing I've learned in participating in debates like this for years and years is that the idea of coming up with some hard and fast rule and sticking to it is just not realistic. The Taylor rule is not as practical. It has no practical content as a guide to monetary policy. All we need intelligent people in the government who are paying attention and trying to do the best they can and thinking about all those issues on an hourly basis and then deciding what to do. That said, it seems to me there's been a persistent bias toward inadequate capital requirements. I've never seen a capital requirement that was as high as I think it should be at any time. So part of this is just getting much more capital into the financial system wherever there's any kind of implicit guarantee. You know, worrying about fine-tuning that, I think, is much less important than just getting some realistic capital requirements for guaranteed institutions.
Ladies and gentlemen, help us all thank this wonderful, wonderful panel. Thank you, authors, for your brilliant, please remain seated. Thank you. Thank you, authors. Thank you, Discussants. Thank you, Chip, for a marvelous panel and wonderful moderation.